Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Elizabeth was moving there. Thursday, December 11th. It's 11 a.m. on the East Coast. That means it's 8 a.m. in California. Guy Adami, ET in the middle, Dan Nathan with a what do they call it? It's a good fit or something, Dan? Isn't that what the kids say?
I'm actually going. Hi, Liz.
Hi. I think it's a tight fit.
Liz, you did a little zhuzh, as you say.
I had a zhuzh. Yeah, this is
looks great, by the way.
Thanks. Shampoo.
And
Shampoo
guys,
is an incredible
what are
thing.
you doing?
Well, I'm zhuzhing as well. But you know what else has a good fit and was zhuzhing is the Federal Reserve. I mean, Elizabeth tweeted about this yesterday, Dan, and let's start there because to me, it wasn't the announcement necessarily that got the market on its horse. It was the fact that all of a sudden out of thin air, they're buying $40 billion of bills for the next few months. It probably goes through April. Maybe I'm off by a month or so. So let's start there, Elizabeth, because you tweeted out you go from nowhere to this seemingly overnight.
I mean, literally overnight. And by the way, there's a comment from one of the viewers says not QE is blank QE. So yes, we can't call it QE. I'm not going to call it QE, but anyway, they're expanding their balance sheet again. So yes, I tweeted this yesterday. I got a lot of mixed responses. Some people were angry. This got a lot of emotion pumping. So some people were angry. Well, no, this is normal. They sort of took his explanation, which was we were going to do this anyway. This is not that big of a deal. Powell tried to explain this away yesterday. Many people are talking about, okay, well, they were going to have to do that anyway to keep their balance sheet the same size. They weren't trying to keep their balance sheet the same size. They were supposed to be reducing it, and they were until December 1st. Remember when we pulled that forward and said we have to end it early, and then suddenly on December 12th, 11 days later, we're going to start again. We were rolling off $5 billion a month in treasuries, and then 11 days after we stopped doing that, we're going to start buying $40 billion a month in treasuries. Don't tell me that's not a big deal. I think that's a huge deal. It was a message to the market that, oopsies, we went a little too far in the QT and things got a little tighter, a little faster than we thought they would. So here we are. We got to come in and support it again. So is this QE in its classic form? No. That happens during a time when you want to pump liquidity in the market because there's economic strife. There's some sort of the capital markets aren't functioning the way that they're supposed to. So this isn't really QE, but it is an indication, in my opinion, that if and when QE is necessary, they are ready and willing to expand that balance sheet right back up to who knows what level at this point. So markets liked it yesterday. I think markets continue to like it at least for a short period of time. And yes, it does provide liquidity in the funding markets, which I'm not going to get into all of the details of, but in the funding markets, which is what concerned them in the first place.
Yeah, Guy, I just take issue. We had Michael Schumacher from Wells Fargo on the program last night, and he said about something like stocks ripped. Stocks didn't rip. I was staring at my FactSet machine. I was looking at every tick. I was thinking, to your point, sometimes we get these big moves and then we get reversals. Well, yesterday we got a small move and today we're getting a small reversal. I mean, just look at that right there. We're in just a range right now, Guy. You call that an inside day, wouldn't you? Is that what the kids call it? So to me, I think to Liz's point about the T-bill buying, what do we see? We see the 10-year. We see, down a few bips, right? We see the 2-year down a few bips, 2.5, both of them. You know what I mean? This is about orderly as you could say. If anything, you could say, we're going to look back on this, but yeah, the markets didn't move after that last cut that we saw, right? And we saw 40 billion. 40 billion is kind of like a rounding error. You guys tell me if I'm being dumb here. And I just think that the fact that Oracle and their guidance is overshadowing what the Fed did as anticipated as this meeting was, I think it says a lot about really, Fed policy right here, guys.
Yeah, no, look, 40 billion, but yes, you're right. And in the scope of a $30 trillion economy, $40 billion a rounding error. But to Liz's point, I think it's the right point. The fact that as quickly as they pivoted, I think that's the thing that should sort of at least open some eyes. And what I said last night, what I'll say here is, they're sort of they're putting foam on the runway. They're sort of putting out a fire before it starts because they see something and they want to get ahead of it. And what I said last night, and I'm curious as to Liz's take, I can make an argument that this really bond bearish, and we can have a debate about that. But what I will tell you, this is really gold bullish, and it's manifesting itself right now, Elizabeth.
Absolutely gold bullish. So $40 billion, yes, Dan, in the scheme of like how big is the T-bill market? Absolutely. It's a drop in the bucket. $40 billion is. My point, and just to reiterate, is just the pivot that happened so quickly and the timing of it. And I mean, originally we thought QT was going to last through the end of this year. So now here we are speeding up the buying, and even to say December 12th, right? Why not wait until January 1st and just make it a clean beginning of the year activity? Because there's something going on that makes them uncomfortable enough that we have to start it this soon. So that's the bigger deal here.
Yeah, and so you're saying it's signaling, if anything, and
Yeah.
Guy, you're saying that it's just kind of getting the gears kind of moving. You know, one thing I was thinking about yesterday, though, because Powell did say it in his prepared remarks, and he was asked questions about it, about AI and its contribution, the spend and the like here. You know, I just wonder, just think about this, okay? Maybe the people can put up, that would be Amanda, the people, BKX for a second. And I wonder if the banks, which have rallied the way that they have, I mean, look at that, right? This move predicated on, right, trading, predicated on productivity from AI, predicated on lending, guys smiling at me, predicated on a whole bunch of things. They are pulling forward a lot of excitement about a continuation of a theme that's coming from an AI ecosystem, right? So let's just say this. Let's just say Oracle is telling us something about all these contracts, right, that have been thrown around. We've been talking about the circular nature with NVIDIA, okay? So let's just say, okay, Oracle needed to hit the debt markets, right, to raise money to fulfill these obligations, and that means to buy NVIDIA chips, to buy Dell servers, to buy, create data centers, which is a whole host of other things, to buy memory, to buy storage, I mean, the list goes on and on, right? To buy Sherwin-Williams paint, because those data centers need to be painted, you get what I'm saying. So let's just say this doesn't materialize. Just say the build up until now was enough. We're not going to spend another $1 trillion over the next couple of years or 3 years or something like that. So then you say to yourself, what does it mean for the banks? What does it mean for their lending? What does it mean for their balances? What does it mean for a whole host of other things? Might we see the other side of a credit cycle because of all this, that we've seen pumping up the economy and the like? So I wonder if the next great trade here is kind of fading the banks, if that makes some sense. And I'll just throw that first to you, Guy. And maybe I'm not trying to get all bared up here, but I think the banks are really pulling forward something that may not really happen in 2026.
There's some people out there that are saying this is sort of the golden age of capital markets and it's never been better. And the yield curve has been, it's favorable now, and it's been getting more favorable, and regulations being rolled back, M&A activity. I mean, there's a laundry list of reasons that people are optimistic for the banks. And listen, with this, I guess if the Fed is going to do this to the balance sheet, that's probably one more reason, with more liquidity in the system. However, I think you saw in the move with JP Morgan the other day, when you had comments out of the CFO, how quickly the market's sort of on this hair trigger to sell the banks. Because I think a lot of people understand that we're probably getting ahead of ourselves in terms of stock prices, number one, and in some cases, valuations, number two. So I think people are going to ride this train. You're seeing it manifest itself in names like Goldman Sachs, which seemingly goes up every day. But I also think that people have a laser focus in terms of what can derail these things. So I would say buyer beware right now.
Yeah, Liz, you get my point here. Is like, let's just say, regulation comes back in a little bit, or the thought of it. We haven't seen that much deregulation, right? So when the dereg actually happens, might it not be that interesting? Let's say, like my point about, the open AI, and let's say everything slows down and Oracle never gets to realize that build and the revenue, and, NVIDIA doesn't get the buys and the chips. And I mean, the list goes on and on. Well, you're going to see less debt. You're going to see issuance. You're going to see less M&A, a whole host of things. And so it could really easily go the opposite way for the banks. And guys mentioned Goldman and Morgan because they're in the catbird seat to do all this banking.
Okay, so in 2025, coming into 2025, banks and financials was one of the most consensus calls out there. Everybody liked them. Everybody was on the horse because of deregulation, because of this increased expectation in capital markets activity, the M&A cycle, all the same stuff that we're talking about now. To the extent that other sectors, even value sectors, are linked to the AI trade, meaning as long as AI spending keeps going, those sectors should do well. I think banks do fall into that category the way that the market's been treating them. Something like utilities also falls into that category. So if your thesis on banks is dependent on the AI trade and the bubble, if we're going to call it that, continuing to inflate to a really strong degree in 2026, then I think you can still be constructive on banks. The risk here is that some of the classic things that should drive banks, I don't think have been driving banks. So things like a steepening yield curve. For a long time, we talked about net interest margin was going to be really positive for banks. As the yield curve steepened, we didn't really see that happen so much in the banking industry. So my gut tells me right now that banks are not trading on those classic signals. Now, if you're positive on the economy in 26, they are a cyclical sector, so I think they probably hang in there just fine. But I'll also tell you this as a little preview. When we looked at the sectors that we thought would do well in 26, we did call out 3 separate sectors, and this is outside of technology and communications. Take them off the table for a second, but sectors outside of that trade, financials is not one of them.
Let me go back to the repo market first. I'm kidding. I'm trying to play off a Dan.
Yeah, but wait, I make that joke last night and I got nothing. And Liz and I both give you a little something. I mean, like, I thought we were a team here, bro.
Wait, when did I not give you something?
Last night? On the Fast Money program.
Did you want me to belly laugh? Well,
I just think you could have done something more, like a little something from the Smirk family, or you know what I mean? Like,
all right, let's try it again. Let's pretend it's last night. Go ahead.
All right, let's get back to the repo market. No, I actually took a beat. You were there, Bill. You were there, and I took a beat like that.
No, it was,
and nobody. There was.
Here's the problem, Dan. When you have to explain the joke for so long, it just didn't work. It's okay. We all have those moments. 2
things, Guy. I just want to get this in there because Liz, you should listen to it, and we give your important part podcast shout outs. Okay. Tomorrow, Luke Groman. Where's Luke from? He writes a newsletter. Brilliant.
Forest for the trees. I mean, this guy is a genius. I could talk to Luke. I mean, I could talk to him for 5 hours about this shit.
No, you really could. So that drops tomorrow. A lot of macro stuff, right? I know you guys hit gold. Now, you asked me when we came in about my fit, right? We have Fast Money live tonight, which is super exciting. Okay, so check that out. Guy's going to be in the crowd. He's going to be talking all the
so I'm going to crowd surf.
But one of our most listened to and viewed podcasts away from the ones we do with Liz this year was a guy named Louis Vincent Gave. And he's a macro strategist. He's a brilliant guy. That was Peter Bookvar introduced us, and we did this pod, I want to say 4 months ago, and it was awesome. We're doing a follow-up with him tomorrow. It's going to drop Monday. But I'm also going to a lunch that he is hosting. Vinny and Porter are going to be there. Peter's going to be there. So really excited about that. That's why I'm all dressed like this.
Okay.
I just want to say that. So, so let's go back to the repo market. See, now it's funny.
Why not?
No, it is funny.
Reading it
enough times, it becomes funny. Real quick, throw this up from Wavy McFly, and I want to get this out there because here's somebody that's here every single day. He's been with us. And this is, listen, we get a lot of shit. I get a lot of it every day, and I acknowledge it. But this is as nice a compliment, I think, that we can be paid. I've been in the financial markets for 23 years, and you guys have made me more excited than I've ever been. I just want to thank you guys and the whole risk reversal team, of which Elizabeth Thomas is part of. So, Wavy, we appreciate that. And I mean that sincerely. That, to me, sort of offsets the 100 shitty things that I get on a daily basis. So thank you. But Liz has got to get out of here at 11:30. But real quick, Elizabeth, bond market. I made a point that I think it's bond market bearish. Am I right to look at it that way, or am I sort of getting ahead of myself?
I think you're right to look at it that way on the long end. So I'm going to say 10 years and beyond. I think you're right to look at it that way. On the short end, particularly 2 years and shorter, if the Fed's buying securities, I'm on board on the short end of the curve because I'm not fighting that, right? And whether it makes sense for them to do it or not, whether we think it's inflationary or not, whether they've caved to political pressure, all the reasons that this may be happening, you got to get on board. And that's the whole don't fight the Fed thing. So if you hold short-dated treasuries, or if you're interested in getting into the short-dated treasury market, I think it's fine to do that right now, and it's fine to keep holding them. But on the long end, now I want to make a point here, though. We've talked about the long end of the curve for a while, and yes, it has been rising. Yes, it's risen since the first cut this year that happened in September. But when we compare it to 2024, if you look at the reaction in the 10-year treasury in 2024, and if everybody recalls, we had a 50 basis point cut to start that off, and then we cut through the end of the year. The 10-year treasury yield rose 100 basis points from that September 24 meeting through the end of the year. This time, and now as of today, as of yesterday, it was up about 9 basis points since that first meeting this year, or I'm sorry, the first cut this year. Now it's only up about 3 basis points since the first cut this year. So the 10-year treasury has been flat-ish this time, which I think says something about basically the trust that I think people have in perhaps the dollar. I'm not really sure what the appetite is here, but to make the point that the appetite isn't quite as terrible as it was last year during a cutting cycle. But into 26, there are some forces at play here. You've got inflationary forces that just haven't gone away, period. We've got consumer stimulus coming. We've got business stimulus coming. The Fed is now buying treasuries again, expected to continue cutting rates. We've got a new Fed chair coming in May that we'll probably hear an announcement about in January. That chair is expected to be dovish, obviously. So there are some real concerns here about inflation rising. And not to mention, we haven't gotten, obviously, the fiscal situation figured out. So I think the long end of the curve is a risky place to be right now.
Yeah, agreed. Hey, Liz, I know we talked a bit about this. Let's just rip through some of these visuals because I think they're important, just to kind of get a sense for what we've been, what we've had going on in the repo market and what's going on right now.
Yeah. So I'll try to keep this really simple. This is what's called the standing repo facility. This is basically supposed to serve as a backstop, more of an emergency measure for banks to use so they can go in and exchange the treasuries that they hold for cash if they need cash, right? This is an overnight market thing. This is when I've talked about funding markets, this is one of those places. This shouldn't really be used. The Fed doesn't want to see this being used because, as I mentioned, it's a backstop. It's more of an emergency measure. But as you can see, in fall of this year, it started to be used. Now, it's okay. It's being funded. The liquidity is there to help banks. But the fact that banks have come in and started to use it is an indication that they didn't have enough cash on hand. Reserves were starting to fall. We can go to the next chart if you want.
We can move now.
I wish I had right past it.
Yeah.
Okay, so this is the thing that's interesting to keep an eye on. Now, what we're showing here, this is the effective Fed funds rate in blue, and then the interest on reserve balances in the dashed magenta line. I know you guys like that color. So this is what we think really started to concern the Fed. And this is when Powell said something yesterday about it happened faster than we thought it would. This is one of the things that happened faster than they thought it would. So as bank reserves are coming down, they were in abundant territory. Then they came down to ample territory. Then they started to knock on the door of scarce. And they knew that, the Fed knew that because this happened. So these two rates, there's usually a little spread between them. If you look at when this chart begins, you see the spread where the effective Fed funds rate is below the interest on reserve balances. You see how it started to kind of creep up in fall, the effective Fed funds rate. It started to creep up because there was more demand for banks to get this cash. And then the rates started to rise. So once the Fed funds rate started to meet this interest on reserve balances, that's when the Fed started to get nervous. And that was an indicator to them that, okay, bank reserves are now getting to a place that we're a little bit uncomfortable with. We need to pump some liquidity in.
And that's sort of that line in the sand. And I said earlier that, they're putting out a fire before it starts, because if that blue had crossed the magenta, that's when you get into sort of the problematic area. And they're being proactive, which, Dan, I guess is a good thing. I'm not saying anything in a negative way. The point is they recognize it, they saw it. So there are things that have been happening behind the scenes, I guess.
Yeah, and I think we've all agreed it's a bit of signaling, which is fine. And there's been a lot of debate what to call it in the last kind of 20 hours or so. When I think about, Liz, and I know we're going to talk about the growth expectations and what we heard from Chair Powell yesterday, what was really evident to me though is that I don't think they've ever been in a situation where the dual mandate has been just so murky, right? Like there's like a couple different ways to think about it. Okay, if inflation's softening, what does that mean for employment? You know what I mean? Like it just seems very, and that seemed obvious to me, right? But the growth thing is really important, and you just listed a bunch of things that pro growth things that could materialize in 2026, and they're kind of becoming consensus though, if you just think about it, like from the fiscal and the and the rollback of taxes and what the benefits are going to be to consumers and but I don't know. I mean, the growth thing might not materialize, especially if this AI trade comes undone a little bit.
Yeah, absolutely. And I mean, to your point, so when you look at growth expectations in 2026, when everybody thinks growth is going to get better, the market tends to react in that fashion, right? So we're going to see cyclicality pick up, some of the stuff that's happening right now. And even the fact that after that drawdown in November, the Russell 1000 value hit a new high sooner than the Russell 1000 growth. So the cyclical rotation is well underway. The issues that the Fed is facing right now, and I do not envy their position. I'm not here to say that the Fed is, not doing their job well or whatever. They're in a tough spot because their dual mandate is in stark opposition. So they've got inflation that continues to be sticky. They're supposed to fight that the way down. And they've got jobs that continue to weaken. We had initial jobless claims today that came out higher than expected. There are these little pieces of the labor market that continue to show concerning aspects. So their dual mandate literally cannot be solved together right now with policy. That's where they are. So I put this chart in here. You guys have seen this chart before. This is just basically saying they put out their economic projections for the next year. So we're shifting into 2026 now. This is another part of the opposition that we're seeing. So real GDP growth, they raised their expectations since the September meeting up to 2.3% real GDP growth in 26. Unemployment rate stayed constant at 4.4, and then PCE expectations came down a little bit. So if that's the case, if GDP growth is expected to rise this much, why are we cutting rates? Why are we buying treasuries? There are answers to those questions. I'm not going to get into it right now, but if GDP growth goes up that much, we continue along this policy path of cutting rates and buying treasuries, that PCE inflation number on the right-hand side is not likely to come out this way.
See me pointing up, Dan? That means it's going this way.
Correct.
And
that's correct.
And I love the fact that this is the final slide, because this to me tells the story. And you mentioned they're in a difficult spot. Yes, they're in a difficult spot. And this current Fed probably didn't put themselves in it per se, but they didn't, let's put it this way. They definitely contributed to it, but this has been long in the tooth, Dan. And it's that whole thing, uneasy lies the head that wears the crown. And they've been tasked with a difficult problem. Well, they got to figure it out. But the market's going to start calling bullshit a little bit here, Elizabeth. And that's why I mentioned sort of the longer end of the curve. I think that's where you're going to start to see some things fray, and it's clearly manifesting itself in the gold market too.
So I'm going to call an audible here. Can we put a question up that just came in? Chris L3062, something like that? Because I think this is important and it goes along with this conversation. So his question is, why don't pundits ever talk about the long-term inflation rate? That's what's hurting Americans more than year over year. Absolutely. I'll tell you why they haven't talked about it lately. So the Fed looks at things like the break-even rate, what we would call the 5-year, or the 10-year, whatever you want to call it. Doesn't matter how it's measured. Those long-term rates are not up right now. They actually look pretty controlled. So the Fed looks at those. I've got the 10-year break-even rate up right now on my screen. It's at 2.26%. That's not concerning to them. That's what they look at to decide whether or not inflation expectations are anchored. And it's been telling them that inflation expectations are just fine. So there's no reason to really be fighting this that hard. But you are absolutely correct, Chris, that the average American, when you look at the necessary things that they have to spend money on, is still under pressure. You've got food costs, you've got transportation, housing, all of it. still much higher than wage growth has been throughout this period. So there's a mismatch in the data. Everybody knows about it, but there's not much that we can do about it because the system is what the system is. And the data that the Fed looks at is just not going to be the same as what somebody walking into the grocery store every day is feeling.
Yeah. And, just to kind of put a bow on this is like, Fed Chair Powell said, a lot of folks have been saying this who are in defense of, I think Treasury Secretary Bessent has said it probably 100 times. And I know he doesn't believe this, but, about tariffs, it's like, it's been a one-time, guy price, adjustment. Well, tell that to people who have dealt with the cumulative nature of inflation, you know what I mean, over the last 4 years or so. And to your point, if you're going to the grocery store or whatever, I just think the intellectual dishonesty about this is a little silly. Liz, really appreciate the hard work. I know that you have a hard out, so we'll just let you go a few minutes early. But if you guys want to find Liz's note each week, you can go to SoFi.com/on-the money guy, Adami, and that's easy enough. I mean, you guys, you'll remember that where to go to get her note, right, guy? I mean,
it's going to be a lot easier. And again, I know Anthony Noto he signed off on this, but soon it's going to be SoFi.com/Liz, and that'll make everybody's life easier.
Liz, this is a throwback. But I will bet you when Anthony was an internet analyst at Goldman Sachs going back 20 some years, there was a company called Network Solutions. It's still around, but it was public. It was NSOL. That's how it came out, guy. That was the ticker. And I'll bet you he had probably a buy on it. He probably thought it was a good annuity business. You go there, you register your website, you know what I mean? And that sort of thing. I'm just saying, it's probably good cash flow business, good margins and stuff like that. I don't know. Maybe we'll go back. We'll use the Gemini and we'll figure that out.
Yeah, I love the Gemini. By the way, Elizabeth, before you leave, take a look at your Schlumberger. It's now SLB Corp. Now north of 40. Elizabeth was early on that one, as usual, because that's how you roll, sister.
Guy, what did we used to call that on the trading desk, Schlumberger?
Slumburger.
Or slob.
Do you say the slob? You say the schlum, or it's just slum with the ch silent?
I was a Schlumberger guy. Schlumberger. That was me. But I don't know if that's right. I'm just
slob. I called it slob. Liz Thomas, that was awesome. Thanks so much, people. We'll see you back next week.
Thanks, guys.
All right, bye-bye.
She had a dip, as they say. She has the CEO of Warby Parker joining her on her podcast.
Oh, that's cool. I got a dip. Do you wear glasses ever?
I wore glasses. I can send pictures of me with glasses. At my wedding, I wore glasses. I have reading glasses.
Really? Oh, we got to see that.
But I had my eyes. I'll get it for you somewhere. I had my eyes zapped when I was probably over 20 years ago.
Well, if you weren't wearing your glasses, would you have tripped over like Linda's dress or something? Was your like eyesight?
No. I it's just the clarity. I probably needed glasses in high school.
Yeah,
but
that was the excuse. Good craftsman never blames his tools, guy.
No, I'm not blaming anything. But it's
saying,
you see, and then. Well, before we get to Butters, by the way, if it's Wednesday, it's Butters, but today is Thursday, so we're doing it today. And we will have his work. But let me say this.
Yeah.
If you don't know, it's like what you don't know, you don't know. And I didn't realize the clarity. And the first thing that I noticed when I put glasses on was seeing individual leaves on trees. I know that sounds ridiculous.
Yeah.
But that was like a wake-up moment for me.
These are Warbies right here. And a few years ago, I got them. They're just reading glasses. That's all. So I use them for reading.
That's a good fit.
But I will tell you this.
Possibly
the most touching videos you will see on the internet.
When little babies can see for the first time.
It honestly, it's like tear. It's amazing. So I love that.
I'm looking down because I'm looking for pictures of
you're efforting.
Yeah.
All right. If it's Thursday, guy.
Yeah.
We'll get the picture. I mean, we'll bring out the picture. You're really focused on the picture.
I'm focused on Butters too. Go ahead.
Amanda asked me today if I was like ADD, because I was just, like you, you got a question, you got to finish off the thought despite you needing to do something else. And right now what we're needing to do is Butters.
Yeah. Bring it up, bitches.
Okay. So,
let's clean it up. Do it again.
I need you looking at the camera, by the way. You see, you're just not focused right here.
I am. I can hear everything you're saying. I'm looking. Go.
I need eyes like this. All right. If it's Thursday, we get to do a preview of John Butter's note. He is the senior earnings analyst over there at FactSet. He writes the earnings insight blog. You can find it factset.com/insight/subscribe. Go subscribe there. You get to have it in your email box. But Guy, we get to preview it. And so I think his work is getting really interesting towards the end of 2025 because we're starting to look at 2026. He gave us some great data that you and I have been quoting on Fast Money, on some of our other podcasts, talking about how strategists overestimate their earnings over a 12-year forward period, that sort of thing. But now he's looking at the bottoms up target prices for many of these strategists. So for the S&P 500, it is 79.73. Guy, where are we right now in the S&P
8,000. I mean, well, we're not there. That we're basically at 6,900. I'm rounding up, and if you can, it's amazing. Look at just the leap over the last couple of years. I mean, this is a pretty much a quantum jump over what we've seen historically, and a couple things sort of stick out to me. I'm rounding up again, 8,000. Let's call it $320 worth of earnings. I mean, you're getting earnings growth. I'm not going to deny that, but you're also getting multiple expansion yet again on top of what's been a pretty expensive market in the first place. So consensus is what it is. You can see that typically people overestimate by about 6%. But even with that overestimation, I mean, you're still talking about a market that people think is going to do extraordinarily well next year.
Yeah, so basically we're talking about 1,100 S&P points here. And, I guess the other thing to mention about targets, sometimes they get divorced of the earnings estimates, the earnings growth estimates, right? And we just went back and talked about how John was talking about, 6% overestimation, that sort of thing. So it's not, exactly science, right? So when these things get divorced from each other, then you see a lot of these strategists chasing their tails like they did in April, in May. And so obviously, earnings estimates caught back up to where they were prior, I think, to heading into 2025. But again, this is just kind of interesting stuff. And so, however, John writes, over the past 20 years, industry analysts have overestimated their annual closing price by 5.9% on average at the start of the year. So it's basically consistent, right, with what expected earnings growth are. But on the sector level, Guy, if we go there to the next chart here, 11 sectors are projected to see double-digit price increases. The materials, information tech, and consumer discretionary sectors are projected to see the largest price increases. What surprises you there? Materials,
obviously, because it's the first one. Infotech never surprises me at this point. So on the one end, materials surprises me because I would have thought that should be the case. I'm surprised that it is. On the flip side of that coin is financials completely a laggard here as well. So the two extremes surprise me. You want to mix in healthcare. I would have thought that would be better, but obviously healthcare is pretty much driven by Eli Lilly. So take that with a grain of salt. But, materials sort of the outperformer here makes sense to me, but I'm surprised it makes sense to other people as well.
Yeah, and this kind of goes back to that discussion that we had about banks. So if you're thinking about that with financials, if we don't see upside, right, to those numbers, to that those targets, then the stock market, or at least those valuations within the stock market on the financials, just is going to look really that much more extended. And I think one of the reasons why you saw JP Morgan down 4% in a straight line, right, is because if you start doubting the the expenses relative to the growth, and then you got to look at the valuation, and at what was it, nearly 3 times tangible book, which is never traded at, right? So if Jamie Dimon is not using their cash flow to buy back their stock, then why should you be, right? I mean, that's I guess that's where I would think about it, but I don't know.
Yeah, and I agree with that. And I was quick to point out that I said the same thing when Jamie Dimon said it about his stock, but that's when it was a $210 stock, and the stock has risen basically 50% since that point. So I guess I'm wrong all the time. And in terms of that metric, he was, I guess, sort of wrong, but doesn't mean he's not smart to point it out. I mean, banks are expensive here, and you're trading at some levels that we haven't seen since pre either great financial crisis or global financial crisis, depending on what your G is, Dan. My G is great, by the way.
I'm global. I don't think there was anything great about it, guy. I'm just,
Well, again, it's great in the scope of the size of it. The Great Wall of China. It's not because it's a great wall. It's because the size of the wall.
it actually, I've been there. It's a pretty great wall as far as walls go. Like it's better than good, no doubt about it. It's a great
Well,
wall.
the good wall of China doesn't have the same.
No, it's amazing that they thought whenever that was built 1,000 years ago, it was like, ooh, people couldn't get over that Great Wall if they were gonna, you know what I mean? Like, and they couldn't defend the whole wall. So
Of
the
course
fact
not.
that I don't know, it is a pretty amazing place. I hope someday to go back to China. I've been to Beijing, I've been to Shanghai, I went to where the wall is, I've been to Hong Kong a couple times. It is a fascinating place and with great people.
I've been to Canaan and I want to go back.
Okay. All right.
Now, if Doug Cass is watching,
He'll get
which
that.
I'm sure that he is, he will absolutely know.
That a
Now, I
Led
know
Zeppelin?
you
Is that a
don't
Led
get it.
Zeppelin? Is that a Led Zeppelin lyric?
No, that's
Okay.
actually no. It's
Okay.
actually not. It's
Well, he
Carole
did a
King.
lot of the
It's
Tolkien
Carole
stuff.
King.
Hold
I've
on.
been to Canaan and I want to go back.
Not a Carole King fan, but he did Led Zeppelin did a bunch of Tolkien stuff.
Yeah, sure.
All right. Thank you to John Butters, the senior earnings analyst over there at FactSet. If you want the Earnings Insight blog in your email box, then you can go to factset.com/insight/subscribe. Thanks so much for that. Guy, really quickly before we get out of here, this is one of those situations where, the S&P, it looks very mild. It's down 30 basis points, but the NASDAQ 100, the QQQ, is down 1.1%. So if I'm looking at my FactSet screen, it's a split screen, okay? So I see semis, Mag 7, all not doing particularly well today, but I'm looking at the banks as we just talked about. I'm looking at pharma. I'm looking at home builders. I'm looking at your slob and these oil names, right? What else am I looking at? I'm looking at defense. I mean, you know what you do?
Materials.
Oh,
No, it's everything X semis right now.
Infotech.
I mean, if you think about it.
Yeah.
And
So-
people will say that's healthy. I mean, that's the first judgment people make. You know what, Guy? You're seeing a rotation out of semis into everything else, and that they'll view that through the lens of, that's encouraging. And maybe it is. What the hell do I know? But I'll say this.
You know why I don't think it is, and this goes back to a little back and forth that we just had before, that if the Mag 7 and some of the semis are basically getting in front of what might be weaker demand, right, for compute, building out data centers, all that sort of thing, then if we're not going to get the associated earnings growth with those top names, then the S&P is not going to get to 14% earnings growth. Some strategists that we've had on the podcast, they're talking about high teens growth for S&P. So does that make sense? If you
it
don't
does make sense.
growth, and then all the other stuff is just not enough to get to 13%,
Look, you were right about Oracle in terms of what you thought. You were spot on. And, the negative free cash flow on the back of the spend is obviously concerning people. I thought incorrectly that enough had been baked in where you'd get a relief rally back to those that gap, that 245 level. But forgetting about that for a second, on a macro theme, I think there's sort of a rethinking of this whole trade. And very quietly, you have NVIDIA down, I think, about 16% off its all-time high, which is a rounding error given the growth of the stock over the last couple of years. But it's something to continue to watch.
Yeah, that's a horrible looking chart, by the way. I mean, like, if you really think about it, it looks like a Head and Shoulders. The fever has broken, in my opinion, on these names. And I think that when you see, let's say, Seagate and Western Digital and SanDisk and Micron and, some of these competitors like Intel, which is not there, you know what I mean? AMD, when you see these things start to break a little bit, then the fever's broken. And you know what? There's going to be an opportunity maybe to pick up some of these where the valuations get too cheap. And again, maybe the stock performance is disconnected from, the fundamentals or whatever, but they got in my opinion, they got disconnected from the fundamentals on the way up, and they certainly can do that on the way down. Anything, the Oracle thing is interesting to me, Guy. And let's pull that chart up for a second, okay? And we say this all the time. When Oracle announced that contract from OpenAI, they just said, this is the contract. You know what I mean? Like, this is the contract, and this is what we have to do to fulfill this. So That was on investors who went and bought the stock and pushed it up 30%, right? Like, can we just agree on that? Like, that's not the company. Like,
No,
they're
we
doing
say it all the time. I mean, the company just they announced it like they had to announce it, and it was the interpretation of the market that you can you can throw rocks at. Now, I'll say this though, it's also sort of on Oracle, maybe biting off more they can chew. And you've said this for a while. You go back to the White House whenever it was in the fall, and Elon Musk, when he was in the good graces of the administration, said very candidly, these companies don't have the money for this stuff. And he was, I guess in some ways he was right. No, not in some ways, in a lot of ways.
That was going back, that was one of the first sort of tech, confabs or whatever you want to call it in the White House. It might have been right after, I think it was like a week or two after inauguration. And it was Masa-san from SoftBank, right? And they were going to be supplying a bunch of the money, right? Sam Altman from OpenAI and Larry Ellison from Oracle, and it was called Stargate, and SoftBank was supposed to fund 30 billion of the build out of this, and it looks like, as of right now, with a few weeks left in the year, they've only done like 8 billion or something like that. They were selling off other liquid assets to raise money to do it. And Elon's tweet was, they don't have the money. While these guys were still in the White House with the president, and he hadn't even started dojing yet. You know what I mean? So again, he was very right about that. But it is what it is, guy.
We'll live to fight another day. I'll find the picture. I'll have it up for next week. But we got to go do this Fast Money Live. So a lot of moving parts.
A lot of moving parts. And I'm going to see the Louis Gav. That's going to be kind of exciting here. Maybe I'll have some stuff to report back. You know what I mean, guy?
Yeah. Well, you got the right fit for it.
Right. I'm not happy. They're making us all for the show tonight. I'm just going to air our dirty laundry here. They're calling the show Trading the Holidays. Okay, great. We have Hanukkah, then we have Christmas, then we have Kwanzaa. Okay, so there's plenty of holidays to trade. So that's what we're trading, the holidays. But we have to wear sweaters. Like they're asking us, or I don't know, they're asking, making us wear like holiday sweaters, holiday colors. And I was like, listen, I'm not wearing a bright holiday color. It's just not me. It's just not what I do. So they gave me a navy one. And they're cashmere. They're like nice. I just don't wear sweaters generally. You guys see us here. Like, do I wear sweaters? And I certainly don't wear, a shirt and a tie, which we're going to be wearing a tie underneath the sweater. But here's the one thing I'll say. I'm excited to do the show. I can deal with a sweater and a tie for an hour and a half. You know what I mean? And, we have a great Fast Money family. We love doing stuff with CNBC, obviously. And I'll wear the sweater.
Yeah,
that's fine. I'll wear the sweater. Now, one thing I will tell you, because after the show, which ends at 6:00, then we all go and we do a panel with Melissa Lee, and we take a lot of questions from the audience. And then after that, we go and we have a little cocktail hour. For that period, at 6:01, I'm going to be taking off that sweater and the tie and be putting this sport jacket on.
Okay. You laid it out there nicely.
What will you be doing with your fit tonight?
I've never used that term in my life, nor will I ever use that term in my life. And if I'm at a point in my life where I start to use it, I give people free range to just sort of throw me off, put me on an ice floe like the Eskimos do, and send me out to sea to perish.
Is that what they do? Do they really do that?
That's what they used to do. And when you become a burden on society, or when you say dumb things like my fit, that's when they should put you on an ice floe.
So are you putting me out on an ice floe? Is that what's going on right here?
Say that.
The variable ice flow. Variable? Did I use that?
No. It's not. It is an actual ice floe. They give you, they give you some like caribou meat, and they put you on this thing, and they put you out to sea knowing that you're not coming back.
All right, I got to go.
I mean, if you think about it, I don't want to be a burden on anybody.
This is what sucks about this city right now. And I'm happy all these tourists are here. Like, have a ball. Go to, see the Rockettes and go see the tree and, eat a hot dog off the street.
Knock yourself out.
Go see, Statue of Liberty and maybe a show on Broadway, all that sort of stuff. Like, enjoy yourself. Okay. But I have to go somewhere where literally from Chelsea, where we are, it should take me on the subway, 18 minutes. It's going to take 25. if I wanted to say, let me get in a cab or an Uber, maybe that should be like a 20-minute sort of thing. It's going to take 35.
Yeah.
But I'm not complaining. Do I seem a little salty today?
No, not at all. I got to take a leak, by the way, because I did the Luke. Now I'm here. So if I don't pee, I'm ornery, is what somebody's saying.
That's what Amanda is.
That's Amanda.
All
Amanda also says, can't wait to see Dan in a snowflake tie. Nor can I.
Some people have called me a snowflake here and there.
No, you're not a snowflake.
All right. So tomorrow, Guy and Luke Groman on the Risk Reversal podcast. It's a must listen to. I love listening to him and your guys back and forth. That's A. B, on
put
Monday.
that picture up. Put that picture up. Keep talking. Put that picture up.
No, hold on. I have to approve such things because who knows what's going on right here.
Put that up right now. I don't know where this came from.
All right. That's good. I like that.
Is that AI?
It's got to be AI.
That's crazy.
Jacob.
Hey.
All right. So I'll see you guys later. And then on Monday, we have the Louis Gav. So we got a lot of stuff going on here. People, you and I are going to be back on Market Call on Monday too. 11 o'clock Eastern and 8 o'clock West Coast time. See you, everyone. Thanks.
Yes.